All right, so we're going to have a discussion here on expected move, how to calculate what the expected move is. Okay, there's a few different ways to do it. And Bert, yes, that's correct. You would get it, but if you can go into your settings, and I have an iPhone, so I'm not exactly sure how it works on an Android, but you can go into your settings, and when you get something as a push notification, which this is in the app, it would show up on your screen. Okay, so we're going to go through how to calculate expected move without having to go through all sorts of fancy machinations and mathematical iterations here. Okay, but let's first talk about, what the expected move really is. Okay, and we're going to use TRIP as an example right now. Okay, so first, what we need to do is again, we need to figure out why we're looking at a straddle, the at-the-money straddle, okay, to figure out, to calculate what the expected move might be. Okay, why do we do that? So for instance in TRIP, let's say we want to see what the expected move is to next week. Okay? Why are we focused in on the at-the-money straddle? Oh, that's fair, Lionel. I like that. That's fair. I'll take that. Okay. Well, what is so unique about at-the-money options? I wouldn't say there you go, Barry. I wouldn't say most value, but at-the-money options are completely made up of all premium. Okay, at-the-money options are all premium. Okay. So we use the at-the-money straddle because at-the-money options are all premium, all extrinsic value, okay? No intrinsic value. So what option prices reflect is a certain implied volatility at a certain point in time based on market conditions, okay? And we all know that the more time to expiration, the more premium there's going to be. So options with shorter expiration dates are going to be cheaper than longer ones. Market expected moves are going to be lesser for shorter dated options than they are for longer dated options. Okay, so what we're really measuring is how much premium is in the price of an option. Okay, so let's say, for instance, in TRIP, we want to see what the expected move is, and like I have circled on the screen here, going out to next week. What we do is we look at the at-the-money options, the at-the-money call and put, which is known as the straddle, add that together. Okay, now what you have to make sure is that we're comparing the options that are truly right at the money. Okay, as you can see here, the stock is $39.95. So, we're a nickel off, but that's fine. We can look at both the 40 call and the 40 put. If we add those together, it's about, I'm just rounding off here, about $1.55, right? $1.53 to be exact here, based on the midpoints of these markets. Okay, everybody following along? Okay, so the TRIP September 27th 40 straddle is $1.53 with the stock trading 40. So the market is assessing, the market is pricing in right now, and again, this is all based on implied volatility, guys. Okay, it's all based on implied volatility. So with the implied volatility in TRIP right now of roughly 34%, this straddle is priced at about $1.53. So the expected move going out to September 27th is $1.53, which means the expected range to September 27th would be the current stock price of 40, where it is right now, plus or minus $1.43. So 38.47 up to 41.53. Okay, that is the easiest way to calculate the market's expected move. If we want to go out to regular October expiration, we do the same calculation. Look at the 40 straddle going out there, it's about $3.05. Okay, so the TRIP October 18th expiration 40 straddle equals 305. So the expected range then going out to October 18th would be 36.95 up to 43.05. Now, why does, and is everybody following along with this right now? Okay, why does implied volatility make a difference here? Okay, why does implied volatility make a difference? Nope. It's accounted for in option prices, okay? Or you can look at it the other way and say the option prices are reflected off of the implied volatility. No, Julie, it's all extrinsic value at the money, no intrinsic value. Alan's is on the right path here. As volatility changes, and as implied volatility, which is option volatility, changes, that directly changes the price of our options. As implied volatility goes up, option prices or premium go up. As implied volatility goes down, the opposite happens. So when vol is really low, you get a narrower expected move. When vol is higher, you get a wider expected move. Okay. Does that help? That's how we calculate real down and dirty, easy way of figuring out the expected move. It's all good, Julie. It's all good. Michael, does that help you out? So just, I'm picking something completely random right now. If I was looking at Baidu, the expected move for next week, I'd look at the 107 straddle and I'd say, okay, that expected move is about $3.40 or so. Good, John. Now, those of you that use Thinkorswim, okay, those of you that use Thinkorswim, they have a fantastic tool. It's not even a tool, it just shows up here. So let's go back to Trip here. Okay. Trip shows every stock here on Thinkorswim shows the expected move. Okay, so if you click on whichever expiration you want here, Thinkorswim will give us the expected move. As you can see, their expected move in Trip for next week is $1.51. If you want to go out to October 18th like we did, $3.13. Okay, Steve, they should always be in line. If they're not in line, then I've got to take a look at something because something would be off. Now, I would say the further you go out in time, you will start seeing some discrepancies. Because if implied vol is even off just a tad, the vega component of option, since the vega increases the further you go out in time, the vega sensitivity, even a small adjustment in implied vol can cause a large or larger price differential. Lester, see what I look on the right side of your screen. I have it circled. Awesome. Okay. So a lot of good a lot of really good cheat tools. Cool. So Michael, thank you for asking about this. Let me post this up in the room, and then you'll all have access to it. Well, Randy, this is a supply and demand marketplace, right? Right? Trading is all about supply and demand. So if there is a bunch of demand, and we are the demanders, right? We want to get filled, but the supply isn't there. It's partially there. Then some will get filled, some don't. I can tell you in the case of Monster right now, what happened was the stock did pop very, very briefly up to 59.12 was the high. That is where we saw some of the fills come in. Okay, my guess is if the stock goes up there again to 59.10, 59.15, that area, my guess is many others will be filled as well. Okay? Theoretically, the quicker you get it in, yeah, theoretically. All right, let me wrap this up, get the video up here, and I'll be right back, guys.